Hello, my name is Grant from BeatTheMarketAnalyzer.com, and I'll save you all the BS and marketing hype and just get to the point. Today I'm going to tell you about how to beat the stock market, but not just how to beat the stock market, how to beat it consistently. I'll then tell you 5 ways to make more money with less risk, and finally I'll tell you the first step that you should take today to start beating the market. Now this system is based on Warren Buffett and Benjamin Graham's value investing technique. Value investing is a stock investing technique that is based on factual data, and it works. How well does it work? Well, during 43 years of investing from 1965 to 2007, the S&P 500 has returned 6,840%. During the same period, Warren Buffett's value investing technique has returned 400,863%. That's over 57 times greater than the market return. And it's not just Buffett and Graham that use this technique. There are other value investors such as David Dodd, Charlie Munger, Martin Whitman, John Templeton, Joel Greenblatt, Christopher Brown, Mason Hawkins, Irvin Kahn, Whitney Tilson, and the list goes on and on. But I won't bore you with their details. You can look up their track records, which speak for themselves. Now I'm going to tell you the secret to beating the market consistently. What you want to do is invest in good companies at bargain prices. Simple, right? It's a simple and common sense approach, and it's the same in real life. If you're going to buy a product at a store, you want to buy a good quality product at a bargain price. It just makes common sense. Now, it's the same thing with stock investing, but people complicate it. Now, why do they complicate it? Well, for various reasons, but the media complicates it because the common sense and logical approach to stock investing is not sexy, it's not exciting, and it doesn't sell magazines and get airtime. What they're interested in is the latest or greatest investment, hot picks, IPOs, penny stocks, things like this that cause excitement, and the ups and downs and fluctuations of the market. Stockbrokers, they complicate it and try to confuse you so that you'll be scared to invest on your own and so that you'll use their overpriced services. And then people in general, the general public, they just feel that if it's too simple, too logical, then it just can't work. There must be some kind of mysterious secret to investing. Okay, so those are the reasons why people complicate stock investing, but it doesn't have to be complicated and it doesn't have to be confusing. Now I'm going to tell you about the 5 ways to make more money with less risk. Number 1, you want to stop believing the BS. Now, there are many people out there that do chart reading, stock forecast, and predictions, and they believe they can read the mountains and valleys of the stock and what's going to happen tomorrow. And pardon me, but this is all bullshit. Nobody knows what's going to happen from day to day, and your guess is as good as mine. So instead of believing this speculative guessing, trust the facts and base your investments off proven data. Number 2, don't short-term speculate. Now, the short-term movement of the market is mostly based on speculation, and 2 emotions are greed and fear. People get greedy, and they get excited, and they buy, and then they get scared and worried, and then they sell. So the market goes up and down, and it has these fluctuations from day to day, and even hour to hour or minute to minute. So instead of focusing on the short term, what you want to do is focus on long-term, 5 to 10 years of an individual stock's historical performance, and that'll give you a real feel for the stock's movement. Number 3, you want to prevent information overload. If you go to Yahoo Finance or Google or MSN Money or CNN Money, there's so much information, financial reports and statements and all of this criteria for investing stocks and marketing hype. Do not overload yourself with these fads and trends of money magazines and investing media. They're just going to confuse you and sidetrack you. What you want to do, as I said, focus on individual good companies and a few criteria that prove these companies to be good quality and find them at bargain prices. Okay, the next thing is number 4, avoid penny stocks, IPOs, and mutual funds. Now, with penny stocks, 95% of penny stocks fail. They're very risky and they're not proven investments. So you want to stay away from them. IPOs, Warren Buffett has said that IPOs are almost always a bad investment. IPOs have no proven track record. They don't have the 5 to 10 years historical data, so you can't really tell how they're going to do. So mostly investing in IPOs, it's speculative and it's guessing and very risky. Mutual funds. Now, mutual funds are very popular, and our media has made them the thing that you should invest in, and also stockbrokers promote them. Now, why did they promote them? They promote them because it's an easy package. It's an easy vehicle to invest your money, and they put your money in this, and then they don't really have to worry about tending to your account, and they just collect your maintenance fees. Also, they're so watered down, so diversified, that they never really make a lot of money, and in most cases they don't really lose a lot of money either. They're just kind of so-so, and you'll never really see much gain out of them. The other problem with mutual funds is their fees. Their fees are very expensive when you're using traditional brokers, and even if you do make a return, usually it's reduced by the fees, or sometimes you just break even when you add in all your fees. Here's an interesting fact about mutual funds. Out of more than 7,000 mutual funds, 8 have beat the S&P 500 every year for the past decade. Seriously, 8. And that's one of the most important statistics that you'll want to concentrate on when thinking about investing in mutual funds. They're just not a very good investment to make a lot of profit. Okay, number 5, stop giving your money away to money managers. Here's an interesting fact. Over 70% of fund managers fail to beat the market consistently. There was even a coin flipping experiment where they took 300 college students' ability to guess heads or tails on a coin versus 300 money managers to guess good investments. Turns out the money managers had no better chance of picking good investments than the college students had at guessing heads or tails. Therefore, we can assume that money managers have no better chance of picking stocks than we do. Also, money managers typically charge very high fees. My money manager, for example, charged me $30 to $40 per trade. And that's typical, usually $30, $40, sometimes $50 or more per trade, whereas if I use my online trading account, I only pay $10 or less per trade. Also, most importantly, money managers don't care about your money as much as you do, and that's the realization you have to come to. Therefore, I think that we can all agree that based on this information, we're actually better off taking control of our own money and investing in safe, quality companies at bargain prices. Now, what can we do today to take control of our money and start beating the market? Well, the next step is to set up an online trading account. And you can set up your online trading account with many different trading account companies. I personally use Scottrade, but there's Trade King, E-Trade, various other ones. They're pretty similar. It doesn't really matter. Scottrade, for example, is especially easy to set up an online trading account. You can set up the account all online for free and actually start trading within the same day. Scottrade also offers some promotional codes for free trades. If there are any current promotional codes, then I'll post them in this video. You can use these promotional codes for free trades, discounts, something like that. If you already have a friend who uses Scottrade, then you can use their promotional code. If you already have a traditional brokerage account or a money manager, then it's also very easy to sign up an online account and then just transfer everything over from your money manager to your newly set up online trading account. After you set up your online trading account, the next step is to find good companies to invest in. Now, this technique is based off of Warren Buffett and Benjamin Graham's value investing technique. So first I'll talk about how to find good companies, and next I'll talk about how to find bargain prices. First, how to find good companies. Let's look at what Buffett did to find good companies. He looked at earnings performance, share price growth, debt levels, profit margins, owner earnings growth, and handling of shareholders' money. Now, if you're confused by these terms, don't worry, it's understandable. Even experienced stock investors get confused because there's a lot of data out there, and sometimes too much data, people get overwhelmed. The good news is that you don't need all of this data, and there's a few essential criterion that we're going to focus on, so you don't have to worry about the rest, which will sidetrack and confuse you. So most importantly, we want to look at return on equity, which is ROE, and also dividends yield. Now, return on equity is very important, and it was one of Buffett's favorite measurements because it took into account a lot of things in one measurement, such as income, assets, debt, profit margins, and other things, and it gives you an overall view of the company's performance. Another thing we're going to look at is dividends yield. Now, dividends yield is important because it tells you directly how much money the company is going to pay you. Now, this criterion directly affects how much money you make. Now, other people focus on different criterion, and sometimes this criterion doesn't really affect you directly. Such things as unemployment levels, politics, currency rates, things like that. It has very little direct effect on the bottom line, which is how much money you're going to make from your investment. So instead of focusing on this stuff, just focus on the most important essential criterion that will give you the best overall picture of the company's performance. Along with return on equity and dividends yield, Buffett would also look at other criterion, such as 5 to 10 year price growth, 5 to 10 year earnings growth, or EPS growth. He would also look at ROIC, or return on invested capital, gross profit margin, PEG ratio, or price earnings growth ratio, and the ability of a stock to recover during an economic downturn. So just looking at these few criterion instead of all of the information, we're drastically reducing the overload of information in evaluating stocks. Now, this is great for us because it saves us a lot of time in finding good companies. The problem is that even with a small number of criterion, the manual process of evaluating stocks is often tedious and takes a long time. I know from personal experience, it would usually take me 30 minutes or more to analyze one stock manually. Now, the reason why it took me so long is because I would set up an Excel spreadsheet and I would go to different websites such as Reuters, Yahoo Finance, MSN Money, and so on, and I would find the data that I needed. The reason why I had to go to different sites is because not all the information is on one site, so you have to jump around. The other thing is that sites will often charge you a fee to get this data. They don't provide all of the data for free. And especially when you're trying to get 5 to 10 year historic data, they'll often charge you for this information. So let's say that we did get the data that we needed, and we punch it into our Excel sheet. Now we still have to compare company A to company B and see which is the better company. After we do that, we compare company A to C, and so on. Now, doing this can be very educational because you can see the strengths and weaknesses of each company, but you can see that it'd be very tedious and time-consuming. Plus, you're limiting yourself to the amount of time that you have. You couldn't analyze 500 stocks in one afternoon, or even in 1 week. So you're really limiting the number of good companies that you can find. But let's say that you do find a handful of good companies. You still have to find out if these good companies are at a bargain price. So now I'm going to talk about the second part, how to find out if a good company is at a bargain price. So how do we determine if a good company is at a bargain price? Well, we're going to use Benjamin Graham's intrinsic value formula. Intrinsic value is an estimated value of a company based on earnings and other factual data. Once we find the intrinsic value, we can find out if the company's at a bargain price. For example, let's say that company A has an intrinsic value of $100 and the market price that it's selling at is $60 per share. Then we can see that its value is more than its selling price, and therefore we can say it's at a bargain price. But before we buy, we'd still want to make sure that we're safe and eliminate our risk even more. So
click the link right below this video to get started. And remember, if you decide at any point within the 60 days that this isn't right for you, I'll send you a full refund, no problem. You'll just have my sincere thanks for at least giving it a try. So click the link below, and I'll see you on the other side.